All right, good evening, everyone. Good evening. Can we all hear me?
Yes, I can. Good
All right,
afternoon.
thank you for taking our good afternoon. I trust we're all doing great today. So welcome to class. Our topic for today is commercial development of fintech. My name is Dennis Williamson. I'll be your moderator. Sorry, I'll be your moderator for today's class. So not to waste any time, I think we'll just get straight into today's business. I would like to introduce our mentor for today. We are having a single mentor in today's class. Okay, but before I read his profile, okay, I noticed that class is a bit scanty. Please, um, can we send reminders to our different subgroups, letting other mentees know that we've started class and the session has officially started. So please, if you can, I would really appreciate if you can send reminders into the subgroup. Let's have quite a number of people in today's session. I'm sure we are quite a lot on the main fintech group. I think we are there about almost 30 in that session, and you know, we expect to have more people joining. Please give me 1 minute. We'll soon get back to the business of today. All right. So good afternoon, everyone. Welcome once again to class. Thank you so much for joining in. We are currently in week 2 of our Gypsy Mentorship and Internship program. And like I earlier said, our topic for today is commercial development of fintech, open banking, embedded finance, and the world of payments. So in today's session, we'll be having just one mentor. Hopefully, he joins us very soon. We're trying to get a hold of him. Our mentor for today is Mr. George Onyewichi. Mr. George Onyewichi currently heads fintech engagements for First Bank and its subsidiaries across Africa at its Digital Innovation Lab, setting up and driving the bank's fintech strategy. George is a link that connects technology, business, and At ecosystem partnership is at the intersection of products, partnership, and ecosystem building. He has led the tech solution product development for the SME banking business of a leading commercial bank, and has taken numerous financial and non-financial products from idea to markets and growth. He has led digital transformation in the client's engagement process for leading commercial banks, including one of Nigeria's banking industry first end-to-end account opening for corporate accounts and SME digital lending. His team has won numerous awards for powering growth of SMEs. He also provides advisory for Africa towards developing blockchain infrastructures and building the operating system for African businesses on the blockchain. and host knowledge sessions on blockchain application to various industries within the African context. So we would, Mr. George will be our mentor for today, for today's class. Hopefully, like I said, we hope he really joins us shortly so that we can get into the business of the day. But while we wait for him to join us, please, I would like to kindly confirm if we have both presenters for today's session in class.
Yes, sir.
Okay, Emanuela, are you saying something?
Yes, I'm presenter for group 2. Presenter for group 2, sir.
Okay, you're presenter for group 2. Please, do we have a presenter for group 1 in class?
Yes, we do. Good afternoon, Mr. Williams.
All right, thank you so much, Favor, if I'm not mistaken, and Emanuela. All right, so what we will do while we expect Mr. George to join us shortly is that we'll be taking presentations firstly, and we'll try to make sure to get over to him as soon as possible while we do that. So please, you can kindly start by, we will kindly start the presentation. We'll take 15 minutes there each for the presentation, and then I'm sure we'll be able to get to the business of today. So please, group 1 presenter, if you're with us, kindly do well to share your screen, right, and start your presentation for the next 15 minutes. We'll take group 2's presentation, and then we'll move into the topic for today. You're welcome, everyone. Okay, you're welcome once again. So group 1 presenter, if you're ready, we're ready for you.
Please give me a minute to share my screen. Can everybody see my screen?
Yes, we can. Thank you.
Okay. 1 minute. Okay, good day, everybody. My name is Adams Favor, and I'll be making this presentation on behalf of Group 1. Our topic for today is commercial development of FinTech with a focus on open banking and embedded finance. Briefly, we'll be talking about open banking and embedded finance and maybe other areas of these subtopics. As we already know, FinTech is where finance and technology meet to create innovative digital solutions. It is basically the use of digital technologies to deliver financial services and solutions. Financial services like online banking and peer-to-peer lending and so many others come under the umbrella of FinTech. Now, what is open banking? Open banking is a financial model that allows third-party financial provider access to a consumer's financial data in a traditional banking system through the use of application programming interface, that is through APIs. Traditional banking gives third-party financial institutions access to consumers' financial data. Oh, sorry. So why do people go into open banking? Why do companies invest in open banking? One is because open banking gives consumers access to a wider range of financial services, including lending, financing, and financial advice. Another reason is because open banking allows for more personalized banking experiences. Open banking also encourages competition and innovation. Now, there are several regulatory frameworks for commercial development in FinTech, one of which is CBN, the Central Bank of Nigeria. Now, Central Bank of Nigeria plays a key role in regulating the sector through guidelines such as the regulatory framework for sandbox operations and the guidelines on open banking in Nigeria. The next regulatory body is SEC, that is the Securities and Exchange Commission. This body regulates digital investments and crowdfunding. It provides rules on how crowdfunding should be carried out and legal backing for online fundraising platforms. We also have the Nigeria Data Protection Commission, that is NDPC, which governs data privacy in FinTech operations, ensuring compliance with global standards. And then we have NITDA. NITDA provides guidelines for digital financial services. So some key compliances that are required of FinTech businesses are regulatory licensing, capital adequacy, that is having enough capital to commence businesses. Regulatory licensing being that these regulatory bodies have licensing that they give FinTech companies to operate. So for them to be able to comply with this requirement, they should meet up with or obtain those licenses that enable them to operate as FinTech companies. We also have the anti-money laundering and combating finance of terrorism requirement, as well as the consumer protection and fair lending requirement. More so, there are security and privacy concerns of open banking, and one of which is data breach. Sharing customers' financial information with third parties has the potential possibility of causing data breaches. It could cause fraud, identity theft, leak of confidential information of clients that bank with these traditional banks or organizations, that way, or financial institutions, is a better description. And the next one is authentication and authorization. Now, in the course of open banking and sharing financial information of consumers, there could be a case of unauthorized access to confidential information. It is seen as a privacy concern in open banking. Another is API security. Now, APIs are the backbone of open banking, but they can be vulnerable to attacks like injection attacks or faulty imputation validation. So it is important to secure your API to prevent malicious activities. Now we have third-party risk. So third-party risk basically when you try to, or when these financial institutions try to share consumer information with other third parties, this third party they are sharing this information to might not have the necessary security system in place to provide protection for the data they are receiving, and that could lead to a breach from a third party angle. For instance, First Bank is sharing the information of its customers to Kuda, and Kuda does not have the proper security in place to protect the data they are receiving. Could lead to a breach from Kuda's angle. I'm just trying to paint a picture. I don't know if it makes sense so much. So, impact of open banking on traditional banking. The impact of open banking on traditional banking includes, but not limited to, increased efficiency, access to new technologies, cost reduction, and enhanced customer experiences. Quickly, we'll move to embedded finance. So consumer adoption and trust, before embedded finance, we talk about open banking and embedded finance transforming financial services by enabling seamless transaction and financial accessibility within digital platforms. Basically, what is open banking and embedded finance doing in our financial institutions today? One of which is enabling seamless transactions. Another one is consumer trust for institution-wide spread of adoption with key factors including security, transparency, and reliability. Also, challenges such as awareness gaps, behavioral inertia, and fragmented ecosystems must be addressed to encourage consumer adoption of open banking. Strategies like educational campaigns, simplified UX design, strategic collaborations, and regulatory engagements can also enhance trust and usability. So, what is embedded finance? Embedded finance is the integration of financial services like banking services into non-financial platforms. Basically, embedded finance allows consumers to access loans, payments, insurance, savings directly in the apps or websites they use without visiting traditional financial institutions. For instance, our consumers are able to shop online and they do not need to leave the shopping app or website to make financial transactions like paying for the goods and services they have bought. For instance, Jumia has this app, or not app, but a sector of it, which is the Jumia Pay, that allows consumers or customers to pay for their application and conduct other financial transactions while on the app. That is the simple explanation of embedded finance. You are on one app and you are able to conduct financial transactions while you are still on that app or platform without having to deviate to other banking institutions' websites to make money or financial transactions. So the next is integration challenges between fintech and traditional banks. The major challenge in integrating these entities is fundamentally different infrastructure, technology, and regulatory approaches. For instance, I'm going to give the example of agility and speed. While traditional banks provide regular speed or are unable to provide the same speed that fintechs provide in giving consumers their services, this is because the consumers in traditional banks or being managed by traditional banks, the amount of consumers being managed by traditional banks totally outweighs the amount of consumers being managed by fintech companies. So the little amount of consumers they have gives them an edge on speed. So for instance, First Bank has a platform of over 250 million consumers, and Kuda Bank or OPay or PalmPay has like 20,000. The rate at which PalmPay would respond to its clients is different from the way First Bank would respond to its client because of the kind of consumer platform they both have. So, and another thing, most people in Nigeria today prefer to use traditional banks like First Bank, UBA Bank, GTB Bank for their savings and FT business transactions. But small business owners who are into quick transfers and just this transaction might not involve FT amounts, might want to involve or invest in fintech companies because these companies are able to provide very fast transaction service. Examples, OPay and Kuda. The way you receive bank alerts when you use OPay cannot be compared to First Bank, even though First Bank is fast, but OPay is always very, very, very fast, and it is one of the advantages of fintechs over traditional banks. So opportunities for SMEs, that is small, medium enterprises. Now, one of which is digital transformation and e-commerce. Advertising online on platforms enables SMEs to reach a wider audience, engage their consumers, and drive sales without the cost of traditional advertising. More so, SMEs have the opportunity to obtain government support, funding programs, and training through SMEDEN platform. And thirdly, with the rise of cross-border e-commerce and free trade agreements like the African Continental Free Trade Area, SMEs now have the chance to expand beyond domestic markets. They now have a better platform to put their business out there and grow without incurring the cost of traditional advertising or traditional forms of commercial businesses or transacting with consumers from different parts of the world. So case studies of SMEs leveraging embedded finance. Embedded finance is transforming the way small and medium enterprises in Nigeria access financial services, enabling them to grow and thrive. Now, most SMEs have incorporated financial services into their daily operations by integrating real-time payment notifications and efficient bill payment services directly with their accounting software. This seamless integration simplifies financial management and provides up-to-date financial insights. For example, some B2B marketplaces have integrated invoice financing options, allowing suppliers to receive immediate payments while offering buyers extended credit terms. This not only improves cash flow for suppliers, but also enhances the attractiveness of the marketplace. Another fintech company that is thriving right now is OnePipe. Now, this Nigerian fintech company has been a pioneer in embedded finance by integrating financial services into non-financial platforms. OnePipe allows small, medium enterprises to access credit and financial solutions seamlessly. For instance, in 2021, OnePipe raised 3.5 million to expand its embedded finance offerings. The role of technology on platforms. Technology platforms power embedded finance, enabling seamless integration of financial services into non-financial apps like retail, travel, and social media. Instead of redirecting users to external banking apps, technology allows payments, lending, and insurance to be offered natively within these platforms. Some key technologies enabling embedded finance are application programming interface, that is API. API connects financial services with non-financial platforms. They enable payments, know your customer verifications, fraud detection, and real-time data analytics. Another key technology enabling embedded finance is digital wallets. Now, this digital wallet ensures to secure store payment credentials and digital cash. They allow fast in-app transactions without switching apps. For example, Uber integrates payment directly into the ride-hailing app. The next is regulatory compliance for embedded finance. So the key regulators and their roles for embedded finance are CBN, Central Bank of Nigeria, which regulates banking, payments, and financial services, providing regulations on how these areas should operate. Then we also have SEC, that is Securities and Exchange Commission, which oversees capital markets, investment, and crowdfunding. Then we have NIDDA, which is National Information Technology Development Agency, which ensures data protection, cybersecurity, and data payment regulation. So some key compliance requirements are licensing and registration, that is to obtain necessary license from CBN, SEC, or other regulators. So depending on the area you are working in as a fintech, there are licenses you ought to obtain from regulatory bodies like CBN and SEC. So when you are into investments, capital market and investment, there are compulsory licenses you must obtain from SEC before you can carry out business or you can operate in that sector. Another is to register with NIDDA and other regulatory bodies. We also have AML and CFT compliance, which implements measures to prevent money laundering and terrorism financing. Then you have conduct know your customer checks. It's a compliance requirement. Then monitoring of transactions for suspicious activities. You have data protection, that is complying with data protection regulations as has been enacted by NIDDA. Then we have implementation of secure data handling and policies. So conclusively, fintech's growth through open banking and embedded finance is revolutionizing financial services by enhancing accessibility, integration, and consumer focus. In Nigeria, these innovations expand financial inclusion, simplify access to undeserved populations, and empower businesses across industries to embed financial services within their platforms, boosting efficiency and engagement. Globally, these technologies promise to unlock opportunities for a more inclusive digital financial future. Thank you very much.
All right, thank you very much, Favor, for that presentation. Well done to you and your group for putting that together. It was really a nice presentation. So, okay, we'll be heading over to group two. Well done once again. We'll be heading over to group two for their presentation. Group two, please, you can go ahead and start your presentation. I think Mr. George is with us in class. Thank you so much, sir, for joining. We are currently taking presentations. After presentations, then we'll get over back to the business of today. So please, can we have the two presentation?
Okay, so I'm trying to share. Good afternoon, everyone. Can we all hear me?
Yes, good afternoon. We can hear you.
Okay, all right. Our topic is commercial development of FinTech. I'm Emanuela Satimen, and I'll be presenting for Group 2. So we seek to discuss the world of payments and FinTech and financial inclusion. Our presentation seeks to examine the impact of financial technology on global financial landscape, focusing on digital wallets and mobile payments. We'll be discussing how these innovations have improved transaction efficiency, accessibility, and security, while exploring their evolution, current impacts, and future trends. FinTech has evolved from basic financial apps to advanced ecosystems, incorporating AI, blockchain, and cloud computing. The early 2000s saw the rise of online banking and e-commerce, which led to the development of mobile payments and digital wallets. Companies like PayPal, Alipay, and M-Pesa were key in providing secure, efficient alternatives to traditional banking. So digital wallets and mobile payments. A digital wallet is simply like a software system that securely stores payment information and passwords for various payment methods and websites. While mobile payments are financial transactions made via mobile devices, often using digital wallets. So these two together eliminates the need for physical cash, and they provide seamless payments experiences. Examples of these include PayPal, M-Pesa, etc. We believe that the future of digital wallets will be shaped by innovations like biometric authentication, cryptocurrency integration, and decentralized finance. AI will also play a key role in fraud detection and delivering personalized financial services. Cross-border payments and solutions. FinTech has innovatively addressed the high costs and inefficiencies of cross-border payments, with companies like AOLX offering faster, cheaper, and more secure transactions using APIs and digital infrastructure. Cross-border payments allow global purchases without currency or regional restrictions, and many businesses now integrate them into their digital products. DLT could transform or improve cross-border payments by enhancing efficiency and transparency, lowering operational costs and offering digital identities for better compliance. DLT has the potential to reduce reliance on intermediaries and lower costs through regulatory frameworks and market dynamics. Oh, sorry. DLT has potential to reduce reliance on intermediaries and lower costs, although regulatory frameworks and market dynamics will influence its adoption. I'm just giving a summary. So moving on, cryptocurrency and blockchain payments. I think we all know the meaning of cryptocurrency, but cryptocurrency is like a digital or virtual currency secured by cryptography. It consists of exchanges, wallets, payments, mining. In payments, cryptocurrency enable direct transactions between individuals without relying on traditional financial institutions like the banks, using blockchain technology to record transactions. More businesses are accepting cryptocurrency payments, and this in turn makes cross-border payments more efficient and secure. We have here cryptocurrency in payments. It allows people to make payments directly without relying on traditional financial institutions. Moving on. The benefits of using cryptocurrency cannot include increased efficiency, decentralization, innovative payments models, and programmable money. These are self-explanatory. So increased efficiency means that cryptocurrency transactions are usually faster and cheaper than traditional methods. Then decentralization simply means that cryptocurrencies are designed to be decentralized, meaning no single entity controls transactions. Innovative payments models, tokenized assets enable new payment options such as fractional ownership and micro transactions. Programmable money. Blockchain technology allows for automated billing, subscriptions, and supply chain payments. The evolution of contactless payments is the history of contactless payments. So contactless payments have significantly transformed over the years, driven by technological advancements and changing consumer expectations. So the introduction of RFIDs, radio frequency identifications, and NFC technologies, near field communication technologies, allow for a faster and more convenient transactions, with NFC-based payments enhancing security. Furthermore, the rise of smartphones and mobile wallets, as we said before, e.g. Apple Pay, Google Pay, has accelerated this shift using NFC and biometric authentications for secure, seamless transactions. Case studies in 2022, mobile wallet transactions exceeded $9 trillion, highlighting their growing popularity. Blockchain and DeFi are further enhancing security and transparency in digital payments. Conclusively, we're seeing that contactless payments reflect the broader digital transformation in finance, with ongoing advancements in security and convenience. And as technology evolves, contactless payments are set to become the dominant payment method. FinTech and financial inclusion. I'll be focusing on the challenges of this. So despite its importance, the challenges to financial inclusion in emerging markets include endemic poverty, unaffordability of services, widespread financial illiteracy, distrust in formal financial systems, regulatory barriers, and infrastructure limitations like limited internet access and unreliable power supply. FinTech plays a key role in improving financial inclusion by offering innovative, automated financial services. It provides solutions like digital banking, mobile money, and peer-to-peer lending, which help reach undeserved communities without extensive physical infrastructure. This is how FinTech bridges the gap. So how are FinTechs uniquely poised to improve financial inclusion? They are uniquely positioned to improve financial inclusion due to their ability to lower consumer costs, leverage technologies like blockchain and AI, provide user-friendly platforms, and offer scalable, flexible solutions. Microfinance and finance collaborations and FinTech collaborations. Microfinance provides financial services to those without access to traditional banking, such as small businesses, while FinTech refers to technologies used in the financial sector. So the collaboration between these two enhances financial inclusion, improves efficiency, and expands access to financial services, particularly in developing regions. This partnership addresses challenges in the financial sector, particularly credit accessibility for small businesses. It also promotes economic growth and financial inclusion, as we said before. So by collaborating, FinTech companies and microfinance institutions can access advanced technologies like mobile payment platforms, automated credit scoring, and data analytics. These tools improve operational efficiency and allow MFIs to offer customized financial products, such as digital lending platforms that simplify loan applications and credit assessments, thus increasing loan accessibility for small businesses. However, all these are not without their challenges. So possible challenges of FinTech and microfinance collaboration include poor infrastructure. Inadequate infrastructure in rural areas hinders FinTech's ability to serve the unbanked. Digital literacy. Many unbanked individuals lack the skills to use FinTech platforms. Regulatory requirements. Complex and varying regulatory requirements across regions create barriers for FinTech startups. Trust and security. Privacy concerns and security issues are also common in unbanked population. Verification and identification. Verifying and identifying unbanked individuals is challenging due to limited documentation and infrastructure. So overall, addressing these challenges can enhance the ability of FinTech to drive financial inclusion and create positive social impact. The social and economic impacts of FinTech-driven financial inclusion cannot be overemphasized. FinTech introduces innovative technology-based financial services such as crowdfunding, peer-to-peer lending, blockchain, and artificial intelligence, often through startups. And in Nigeria, FinTech plays a key role in promoting financial inclusion and literacy, offering accessible and affordable financial products to unbanked populations or semi-illiterate populations. Furthermore, Nigeria also faces economic challenges, including inflation, leading to weakened naira and reduced consumer spending power. So in response to this, FinTech offers opportunities for economic growth, job creation, and entrepreneurial development. So in conclusion, by utilizing advanced technology, FinTech platforms can mobilize small funds and provide microloans, promoting a more inclusive financial ecosystem and reducing poverty. Innovations like mobile money have enabled by mobile phone ownership and internet access play a crucial role in increasing financial inclusion, particularly for small business owners and unbanked adults. Okay. Thank you.
All right, thank you so much, Manuela, for that wonderful presentation from you. Well done to you and your team for putting that together. So we We are supposed to take presentations or Mr. George's discourse right now, but he seems to be joining, and I don't know if it's his network issues, but he was on the call just not too long ago, and I'm sure he will be joining us shortly. Let me try and see if I can reach out to him to get him back on call, and then we'll take his session. We'll take questions, and then we'll call it a day for class. But well done to both groups for their presentation. Please just give me one moment to try to reach out back to him to have him in class so that we'll have his discourse for today. Okay, he's back. Mr. George, you're welcome. Good afternoon, sir.
Yeah, can you hear me?
Yes, sir, we can hear you, sir.
Sorry, my network is acting up because I'm on the road. Yeah, but I hope you can hear me clearly now.
Yes, we can hear you.
Oh, okay, that's fine. I just want to clarify because I think while I came in earlier, before my network was a bit up and about, I think I saw something around blockchains, and then I think I saw something around someone talking around SMEs. I just want to clarify the topic for today: commercial development of fintech. Is that it?
Yes, including embedded finance.
Is that correct?
Yes, the topic.
Are you with me? Uh, is it my network or yours? Are you with me?
We can hear you, sir.
He's this thing is frozen. So it's not from my end, right?
Sir, it's not from your end.
Oh, okay, that's fine. So let me just quickly apologies once again. I didn't catch every bit of the presentation, right? But I think from the little I got, it was a bit inside it, just that I didn't know the exact topic I was speaking to. But I just I'll probably just give a few comments around the topic, commercial development of fintechs, right? Firstly, I need us to understand that fintech, just like every other business, right? It's all there to solve problems, right? But the real reason why we're solving problems is because we want to make money, right? It's not like some charity organizations operate as technology companies, but fintechs basically are not charity, right? They are there for the money while they are solving your problem, right? They're solving a problem and they're getting paid. So the commercial part of it, right, is very important, right? So one of the first things you think about when you're trying to set up a fintech is, how do I make money, right? What is the model, right, that I'm going to use to make money? In fact, the answer to that question can literally define how and what you build as a fintech, right? There's something called the business model, right? What kind of business model is going to run the fintech, right? So when you're thinking about the solution, it has to be profitable, right? It has to be, who's going to pay for it, right? Somebody has to pay for it. How's it going to get paid, right? How do I make my costs? So how's it going to get paid? If you're not able to find that answer, you can't start a fintech, right? Because you're going to run down. So when you want to start the business, you're thinking, how am I going to make money, and who's going to pay for it? Sometimes the person that is the beneficiary might not necessarily be the one paying for it, right? But the most important thing is that somebody is paying for it, even if it is not the beneficiary of that particular service that you're offering. As a fintech, sometimes it's the beneficiary that pays for it, right? So you need to figure out, what is the model, right? What business model is going to run this? Is it going to be one whereby it will be subscription based, right? you have to pay me monthly, a subscription fee monthly, so that you can use the service, right? Or is it going to be transaction based? You pay per transaction, just the way when you do a transfer today, right? You see transfer charges, right? There's a charge. So at the end of after the transfer has been made, maybe 10 naira, 20 naira, or 50 naira is charged as the charges. So is it going to be transaction based charges, right? Is it going to be commission based, right? Is it going to be something that is commission based, for example, or interest based? So, for example, when you borrow money from any of all these lending apps, right, and then they charge you interest, right? So, if your fintech is going to be about processing loans, right, you know that okay, I'm going to charge them interest when they take the loan. So it has to be clear how money is going to be made, right, and who is going to pay for it. Now, one of the wrong approaches that we see a lot of people do is where you say, "We'll figure it out later," right? Let me launch first, right, and we'll figure out how to make money later. So you do a free service, right, and say, "Okay, let me launch it free, and then let me acquire a lot of users, and then we'll figure out how to make money." You can use that strategy, right, for any other type of technology business, right? If you have deep pockets, but it's not advisable because you cannot continue to fund the cost of doing that business. But that strategy would not work if you're trying to do a fintech, because each transaction you do for the customer, you're going to pay something somewhere, whether it's regulatory fees, whether you are paying for infrastructure. It's going to cost you money. So if you're not charging money to the customers and you're doing it free, right, you have to be very careful of that business model to say, okay, let me do it free, right, and then um, pay, charge them later, or figure out how to make money later. You have to have very deep pockets to be able to do it. So I guess some of us Nigerians like freebies, right? Some of us that have used guys like Kuda, right? When they started, right, and transfers were free. I think I don't know if it's still free. I think they're doing maybe 25 now or something. But when they started, transfers were free, right? In Kuda, and people were wondering. In one particular year, they declared 6 billion naira loss. I don't know some of us that following them closely. They declared a loss of 6 billion, right? And people were shouting that, hey, how can this company declare a loss for 6 billion? And some people were wondering, how did they get a loss for 6 billion, right? Without forgetting that, look, there was a time where those guys were doing free transfers, but that thing that was free to you was actually being paid for by the company. So the question is, if you want to adopt that model, do you have 6 billion deep pockets to keep paying for it until you acquire 3 million users like Kuda? And that's okay. Now we can now bring in charges. So it's a very risky model, right? Business model to do. Um, it is best from the beginning to capture value, right? To be able to charge a fee for whatever it is you're doing. First, you're testing the market response to what you're doing, and at the same time, you're able to be sustainable. So it is very critical that the business model is clear. It's not something that you stumble into. It's something that is very, very clear from the very beginning. And if you're advising any fintech person tomorrow, one of the first things you want to ask as an advisor is, what is your business model? What model are you using to make money for this business? Because if not, tomorrow the guy might not even be able to pay you, right, your advisory fees or your legal or professional fees for those of us that are lawyers in the house. The guy might not be able to pay your fees. So you owe him and yourself a duty to understand how he's going to make money, right? So when you figure out your business model, right, how you want to approach the market, right? Are you going to go B2B, business to business? Are you going to go direct to customers? Are you going to go C to C? Are you going to use the network to push out distribution, right? So when you figure out that model, then you now need to understand, how am I going to distribute my product? How am I going to communicate my product or my service to customers or potential buyers, right? And what is the potential time it would take me to convert any of these guys, right? How long will it take me to convert any of these guys to customers, right? If you if you don't have an idea, some of these things, you're going to struggle, because the entire time you will use to market, let's say for example you're doing ads on Facebook or on LinkedIn or on Instagram, right? Those ads cost money, right? Now you're doing ads, you're using social media channels to try to acquire users, right? And your conversion cycle is not very clear. How exactly are you going to plan, and how exactly are you going to budget? It's going to be a problem. So the the financial side of fintech is as important as the product side, right? It's as important as that idea that I have, that I've now built, right? And I've now launched. So a lot of people are always too excited about launch. I just launched, right? Oh, I'm a co-founder, and I just launched, and then you find out that they are CEO of Nothing Enterprises, because after 6 months they can't sustain paying AWS for what their cloud hosting space. By the time they are supposed to renew their domain next year, they can't pay for the domain anymore, right? The whole thing that you were all excited about, right? And you quickly, some before they even get their first customer, they printed business cards. You get, they've already printed business card and put CEO there. We like title a lot in the country, right? You just see people that are CEO, I'm CEO, co-founder, CEO of this and that, right? So while all those are the fancy side of things, it needs to be very super clear how you're going to make money. Now, from figuring out the model, another thing that is very important you put in mind is something called unit economics, right? If you're, and this is beyond fintech, it's something that it can also be very critical when you're doing business generally. You need to understand your unit economics, right? What does unit economics imply? It means that how much or how profitable am I per unit of my product? So, if, for example, I'm selling stuff for, I'm selling water, right? At 100 naira per bottle, and I'm buying the pack of the bottle water pack. I think it's 10 in a pack. Let's say I'm buying it for 900 naira, right? 900 naira. But I'm selling 100 naira per bottle. So if I sell 10, right, is 1,000 naira. Now, at 1,000 naira, and my cost is 90 naira per bottle. So if I bought the pack for 900 naira, it means that it came to me at 90 naira per bottle, right? 90 naira per bottle plus all the other costs. I took transportation to the place. Probably I was tired on the road. I took pure water. All the other costs that I used in acquiring that pack of water. Let's assume that it comes down to, I spent another, let's say I spent another 500 naira, right, in transport to go and buy that water. If you divide that 500 naira by 10, it means 15 naira per bottle. So I spent 15 naira per bottle in costs, right? So if you add that 15 naira plus my 90 naira that thing is, you ask yourself, that means cost per bottle is costing me 140 naira per bottle, and I'm selling 100 naira. It means that on every bottle, I'm actually losing 40 naira as a loss, right? I'm losing 40 naira as loss per bottle. Now, if I'm losing 40 naira per bottle of water, the question will now be, if I buy 10 packs, I bought one pack for 1,900 and I'm selling 1,000 naira, but I'm losing 40 naira for every bottle I sell. So if I buy 10 pack, right, would I have economic of scale? Would it reduce my cost such that my cost per bottle will reduce significantly, and then I will now be profitable? So that's what people now do as economics of scale, whereby you will lose when you're in the unit level, when you are looking at the small quantity. But if you are able to go do larger quantities, you will break even. But in fintech, right, unit economics is very critical, because a lot of time your cost is not changing. You're using the same cost. So if one customer comes to buy from your website, use your transfer service, and maybe 10,000 customers use it, your cost is similarly same to up to a certain level when you now need to increase your server capacity, blah, blah, blah. But your initial cost of maybe first 10,000 customers is the same. So if one person uses it, you're spending the same money, right, in the same way that 10,000 people will use your application. So what that means is that already for your first 10,000 customers, right, you already spent, your cost is already known. So the question is, if you're not getting up to 10,000 customers, right, how much are you making or are you losing per customer? So your unit economics, you need to understand your numbers. It has to be clear. If not, you will just be in service, and you'll just find that I have 100,000 customers, but at the end of the month, the account is still in red. Why? Because your unit economics is not adding up. When you're adding your costs versus how much you're making from what you're charging people, you're actually losing money on every customer that is patronizing you, right? You are charging the guy 10 naira for transfer. Meanwhile, you are paying 15 naira to the regulator as transfer charges that you are not passing to the customer. So your unit economics is not going to be adding up. Like the example I gave with Kuda, right? That at some point they had a 6 billion naira loss per year in a single year. Why? Because they were doing free transfers. So for every customer, they were paying 10 naira to the regulator on behalf of every customer on every transfer. So their unit economics was not adding up. They were losing money on every customer, right? But on their own business model, they wanted to, first of all, acquire the market before commercializing the market. And that's because they came with deep pockets. So before you look at that thing as a method that you would adopt, you need to ask yourself, do I have the kind of capital or the kind of deep pocket that could have had to be able to do it? Amazon, for example, you hear Amazon became profitable after 10 years. Flutterwave today will tell you I'm not profitable. If you go to they'll tell you they are targeting to become profitable by next year. But they're not yet profitable. They're still declaring losses, right? So you need to be very clear so that even when you're making loss, you know that it's not by mistake. You knew you were going to make loss and you planned for it, right? So that whole area around the finances of the fintech is as important, if not more important, than the product itself. How you make money, right? And who is supposed to pay for the money, and what is your profitability or your loss. It should be very clear, right? Am I making money per customer or am I losing money per customer? If I'm losing money per customer, which is my unit economics is at a unit level, is negative, at what point will it become positive? It needs to be very clear. what in general terms they call break-even point. It needs to be very clear. So you need to be able to do these maths behind the scenes so that you're very clear where you're going to. Else you wake up one day and find out that I can't keep funding this business anymore. I've been funding it from my own pocket. It's not the business that is making the money that is keeping it. It's actually, you're actually taking from your savings to fund the business. And that's because you didn't get your maths right. You didn't get the commercial side right, right? You were too focused on launching the product, solving the problem, and being, co-founder, CEO, without actually understanding your numbers. So, understanding your numbers is very critical, and it is something that you do from the moment you're thinking about even, launching a fintech. The business model should be clear, how you're going to, transfer this product or service to become commercial value to you. Who is going to part ways, and in what way, or in what form? Is it going to be pay small small? Is it going to be buy now and pay later? Right? How are you going to translate this thing to money, and who is going to pay for it? Right? That whole part should be clear. Then another thing that must be in your mind as a fintech is, what is your exit game? What is your exit plan? Most times when you want to raise money from an investor, those are some of the things that they are interested in knowing, right? At what point are they going to exit? And what is going to be the exit plan? Is it going to be acquisition? Somebody's going to buy it out? Are you going to go public? There must be an exit plan. Or are you going to shut down because business is no more working? It's still an exit, right? So the exit has to be very clear, because it is a very key point on the direction that you're going to as a fintech, right? When you want to raise money, how you raise capital, right? How am I going to raise capital? Of course, personal savings is going to be part of your capital, definitely. Family, friends, and fools are going to be part of your capital, definitely. But how do you raise external money? Your best form of raising money is customers through sales. That's your primary best way to raise money, right? Through sales. Raise it from your customers, sell to them, and they pay for the product. Now, but if you need external funding, then you go to VCs and angels. Maybe angels first, then VCs later. If you're able to get access to angels, angel investors are basically the guys that will come in. They know that you're not profitable. In fact, some of them might even know that you have not started even making revenue, and they're able to give you a small check, $5,000 here, $10,000, $20,000, $50,000, or 50 million naira, right? Those amounts are considered small in the fintech, world, right? They are given by angels, angel investors. They will not scrutinize you too seriously, because they know that you're at a very nascent stage. So they know that, okay, fine, this guy is likely not to be making revenues at this time, right? But once you now want to start raising beyond 100,000 US, or up to 100,000 US dollars, then you now need to go to venture capitalists, the people we call the VCs. And those ones are very thorough, because they are in the game for the money. So they want to know, how are you going to, make the value of my money to be times 10 of it within the next, 1 year, within the next 6 months, within the next 2 years. They're always looking at things in very short term, very, very short term. How are you going to triple, quadruple, 10x is usually what they call the lingo, 10x. How will you 10x this money, right, within the next 1 year, within the next 2 years? They want you to grow very fast, right? And that is why some people actually play that acquisition game of, let's look away from profits, let's acquire customers very fast. If you have access to VC that is ready to back such model, if you don't have access to a VC that can give you that kind of money, then you have to raise it from your customers. And why is the best source of raising money is that when you raise money from your customers, even the VCs will want to even give you more money because they know that money is coming in, your cash flow positive, right? So you have to think about what are my funding sources as a business? Is it bank loan? Before bank gives you money as a fintech, it's not as easy. Your cash flow has to be consistent. You have to have good cash flow. Money is coming in, revenue is coming in on a consistent basis from transactions that your customers are doing. So you need to look at your funding sources, right? You need to look at your exit. So these are some of the things that you need to look at when you're looking at the commercial side of a fintech, right? It is beyond the glitz and the glamour of the title of the co-founder or the product or the LinkedIn post that I'm glad, that standard LinkedIn post. I'm glad to announce to you that I've now launched, I'm co-founder CEO, and we have launched blah, 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 blah. You put all the posts and all the razzmatazz around it, and then change title, just change updates, co-founder CEO. Behind all or beyond all of that, you need to look at things from a commercial angle, right? How do I raise capital? Then how do I make money as a business? What business model am I going to run? Who is going to pay me in what way? Am I going to be making money or am I going to be making losses per unit of my product or per customer that I serve? If I'm going to be making losses, at what point will I break even? At what point is this loss going to convert to profit? It has to be clear, right? Is it at my 1,000 customer? Is it at my 10,000 customer? Is it at the point of my 100,000 transaction? Is it at the point of the 1 millionth transaction? Or when my transactions start crossing 1 million monthly, right? So, what is my long-term gain? What is my exit gain? Right? What are we building towards? Are we building towards raising money from VCs and then, of course, exiting, have someone acquire us? Are we building towards, what do you call that now? We're building towards going public, right? On the stock exchange market. What is the exit plan? So that should also be clear, right? So from the beginning of how to raise money all the way to how am I going to exit, you should, give it significant consideration. And then in between of how we are going to get money, right? And at what point, if we're going to get lost, at what point are we going to get positive? At what point are we going to break even? At what point am I going to become profitable? These things are not things that are left for chance. These things are things that are very clear from the beginning of the business. And if you're an advisor to a fintech, or if you're someone that gets to work in a fintech, or someone that becomes the legal partner to the fintech, these are some of the things that are questions that you ask or engage with the fintech owners from the very beginning, so that you have a sense of what is going on and the plan to make sure that um, they actually have very concrete idea of the race that they are running. So I think I will just pause here for now, and maybe if there are additional questions, and then I can take that. And I hope I was very well heard. Thank you.
Thank you so much, Mr. George. You were actually very well heard. Thank you so much for that very insightful discourse from you on the commercial developments of fintech. So basically, what we'll be doing is that we'll be taking questions. So we would like to ask from the mentees, if you guys have any questions, please, you can kindly raise it so that Mr. George can give answers to it. We'll take pictures and then we'll call it a close to class. I'm sure it has been a discourse we've understood so far. Okay, Mr. Oluwadamilola, you can unmute and ask your question. Damilola, you can unmute your question.
Okay. Hello. Sorry. Good afternoon. My name is Oluwadamilola. Thank you so much for your time. I have quite a lot of questions because some of the terms that were used are not entirely, the context, there are things you read up on, but like the context in which you use them now brought some light. When you said those questions we have that we have to ask them about, profits, raising funding, long-term goals, short-term goals, more or less. How do you navigate founders because founders are very spirited people. Sometimes these questions, aside from the fact that they don't have answers to them, how do you navigate founders who find it difficult to share, insights into these things? Because I once met a founder and I did have a question about, in terms of scaling, and he just did not feel entirely comfortable sharing at the moment. And this was at a stage whereby, he was just asking for, informal legal advice. And sometimes founders can be quite exploitative of legal counsel, such that they come to you with a question and, they've used AI to sort of generate an answer, but, they want the Nigerian context. So they may be unwilling to give full answers, just them working at an angle. How do you navigate that? That's my first question. Is it all right if I pause so you can answer before I ask the other questions, or do I just ask them all?
You can ask them all. You can ask them all. Don't worry.
Okay. Then my second question is, in terms of these licenses and obtaining, I think there might be a bit of an uphill task if you don't have a working relationship with people who work within these regulatory agencies, because I've noticed a trend, especially within Nigerian regulators. If you don't know someone that works there from the jump, you may not have insights, or because there are some informal rules. For instance, I mean, even something as simple as business registration. There was a time where I experienced CAC had downtime on their websites, but of course, I couldn't personally access it, but people who already worked within those regulatory agencies were able to still get something done and still report back. And whilst us who, are just green and don't really have anyone, still had to, oh, the website is down. Oh, here's a screenshot. Here's a picture. It's just, how do we break into the stage of having, I mean, where do you even meet these people? Because Nigerian civil servants don't entirely have some sort of networking event or something. How do you build a relationship with people within these regulatory agencies? That's my second question. Then my third question is, in terms of, because in our presentation we did a lot of what's it called, um pardon me, I'm struggling with the term. It's on the tip of my tongue, but okay, let's just move on. you know the whole financing bit and everything, with the whole angel, yeah, that's the word you use, angel investors, whereby they drop money, and because it's a minimal sum and everything, with these angel investors dropping their sum and everything, and they don't really expect immediate returns, isn't there some sort of agreement that that sort of limits their, I don't want to say stake, because I don't think it's entirely stake, because sometimes, I mean, how do you even navigate someone who drops $5,000 and then expects maybe 10% stake or 5% stake or something, when it's grossly undervalued? Yes, that's my third question. Thank you.
All right. Damilola, right? Um,
Yes.
okay, yeah. Cool. Pretty interesting question. The first is how you um engage founders that are not very responsive in trying to let out, or trying to divulge information, or maybe they don't even know, right? The second is about how you can engage, or how you can get to create relationship with regulators, and then the third is on the valuation that the angel investors put behind the monies that they give, right? Did I capture those well?
Yes, yes, you did.
Okay, good. Now on the first issue of how do you engage founders, a lot of it come from the point of how they see you, right? What they see you as. If you are a professional advisor to them, right? So one of the things you understand is the stage that the business is determines how much open the guy wants to be with you. Some of them don't want to give you a sense of how bad things are, right? That behind all that they are showing you is an empty shell. Some of them are not letting out because they are quote unquote, they are actually embarrassed by the reality of, what is happening behind the scene than what they portray as founders. So that's why I say some of them are CEO, founder CEO of Nothing Enterprises, right? It's not as glamorous behind the way they make it seem when they either talk about it, the fintech, or when they advertise it. And now you think that, whoa, this guy is the owner of this company, and behind the scene, maybe there's not even 100K in that account as revenue, right? So a lot of times you might first of all try to come with asking questions that are not directly asking the questions that you're asking, but will give you a sense of how things or the picture of things, right? If you ask the person, for example, insight around um, um, active users, what's like your active user base like? Um, let's say, for example, he says, I have up to 1,000 users now. How many use it? Like how many of these 1,000 is active monthly that use the platform? Maybe it says about 10%. How many percent of it? Maybe say maybe about 20% in your head. Like, okay, 20% is about 200 people that use this platform every month. But what's the average transaction per user? Does the users averagely do more than one transaction in a month or two transactions in a month? So while he's giving you these answers, you're doing the math in your own head. So okay, if that be the case, if users do average of two transactions and he says like 20% is like his average users, and his total user base is about 1,000. That's about 200 active users doing transaction twice on an average in a month. That means 400 transactions is what happens on this platform in a month in an average, right? And whatever it tells you, trust me, is never the conservative answer, right? It's always whatever answer the founders tell you is never the conservative answer. It's always the overstated answer. So that 400 that you are saying, discounted by another 30% in your head, or discounted by another 40%. So you know that, okay, the real transaction in that platform per month probably is about, 2 to 300 monthly. Because like I said, they will give you the most optimistic view, not the conservative view. So whatever it tells you, discounted by another 30% or 40%. So where I'm going to that, you might not be easy to get that direct confrontation with the guy with those answers. But if you understand the space enough, which is where your understanding also helps, if you understand the space enough, there are questions you can now ask the guy that he will unconsciously just give you answers to, that you can now piece it together to have a sense of what the answer to the real question or information that you are trying to get is. I don't know if you get me. So that, for you to be able to do that, is also based on your understanding of the space, right? Whereby you can just ask three questions that are not connected like when you ask them, in the front. But if you understand the space enough, you can actually tie those three answers together to give you a picture of what you are really interested to know. Just ask three separate questions that don't in front, they don't look like they are connected, right? And then behind the scenes, you are putting those three questions back together, like, oh, this is the real situation of things. The other part around how to engage regulators, the best place to find, first of all, you need to be very targeted, right? If you really want to succeed especially if you're either a founder or you're somebody that's a professional advisor and you want to be the guy that opened the doors, to the company, or you want to be the guy that is actually solving, that their regulatory headache or compliance headache, right? You need to be very targeted on the regulators that you are interested to know, the regulators that you're interested to handshake with. It's not, I just want to know regulators. So, this particular company, what are they into? Are they into, they have all these saving investment products. So if they have all these investment products, SEC will be a regulator that will be of interest to you, and then you ask yourself, how do I meet and how do I get to know SEC guys that work in SEC? So you need to first of all be targeted on who are the regulators you are first of all interested to catch. Then the next thing you need to do is one of the easiest place to meet them is events. That's where they lower their guard down. That's where you can easily walk up to, let's say a director there that have just gotten off a panel just before he gets away from the hall, right? They always spend like maybe 10-15 minutes just meet and greet, chatting with people and all. Yeah. Sometimes you quickly just pitch in some of the things that you want to just talk about there quickly. And if it's something that catches his ear, sometimes they'll just give you an appointment. They'll be, okay, now fine, come around the office. Let's talk, right? If it's a situation whereby you need more time to land what you want to land, sometimes you look at targeted events that you might even have to pay, conferences that you might have to pay, where you know that the guys that you want to meet are there. So one of the easiest way to catch them is look at the events that the regulator that you're trying to get is either those events they are the ones hosting it, or they are likely to attend the event because of the nature of the event. So if, for example, there's something happening on trade and investment in the country, you are most likely to see SEC officials there. So you go there, and once you meet one from there, you know at the initial you might not even be able to meet the highest level guys. It might be the mid level staff, the guys that are less guarded. Then from there you create a rapport that will help you even open doors. They can even be the ones to help you secure appointment or accesses to their other bosses internally, right? But if you really want to catch them, your best and most easiest bet is targeted events. That's where you will get unrestricted access to be able to really get these guys. Then of course the other one is going straight to the office, but that one you have to have serious business to do, right? To go there to get an appointment. That's the longer route. But at events, it's very easy to even meet even the minister or the governor of CBN from an event, right? Yes, the bigger the guy, the lesser the time you have with him in that event. So if he's a CBN governor, maybe you won't have more than 30 seconds to just say what you want to say before he moves away from you while he's greeting and people meeting people after he has given one speech in the event. At the end of the event, because then the bigger guys that are bigger than you are the ones that will come and get his attention the more. So you can leave the big guy and go to the medium level guys first. Once you close out those guys can easily give you the access you need to the bigger guys. And then lastly, on the valuation, right? Look, is value is what you ascribe to it. If I give you $5,000 when your business is not even anywhere off the ground, I'm taking the biggest risk, right? Because I've seen nothing. So if I tell you that, look, your business right now is almost worth nothing, and I'm bringing 5K, right? And this 5K, I want 30% of your business, right? The valuation I put on the 5K is based on the fact that, look, the chances of me losing this 5K is close to 100%. It's like 95% that I'm going to lose this money. So of course I'm going to demand more. Other than the guy that comes in, maybe when you have like 100,000 customers, you're making 5 million in revenue per month. Now you have traction that the guy can be much more comfortable. Okay, the chances of my money reducing is the chance of my money going missing or me not being able to make my money back, maybe from 95% is now 50%. It's a 50-50 game. But the guy that is coming in as an angel, when you literally are barely getting off the ground, the chances of him losing that money is close to 100%. So he might decide to value that his 5K, far more. So, and then it now depends on how much you need it. If you're doing well and you have good savings and you don't think you need that external capital, you might say, no, yeah, I can do with this extra 5K or extra $10K, but I can also, the way my business is designed is built to self-sustain. So I can actually still do without it. So if you're not going to give me for 5%, you can take it, you can walk. It's demand and supply. So if demand is higher than supply, what happens? Price will increase. If supply is higher than demand, price will drop. So if the guy wants to give you the money and the way your business is structured, you're not necessarily hot on it, and he's suspecting that this thing is going to blow, I really want to be part of it, he will lower his demand. It's either he meets your 5% and say, you know what, okay, take it at 8%. So it's literally demand and supply, because at that point in time, it's not really empirical, really. All the metrics that is used to calculate it is just what we call vanity metrics. It's not really empirical. It's really about demand and supply, right? How badly you want it, and how much the guy is willing to give it, because he's closer to losing that money than any other person. I hope you got all that.
Yes, I did. Thank you.
All right. Thank you so much, Mr. George, for helping us answer that question. I think someone else was raising their hand. Howell, do you still
Yeah,
want to ask your question?
yeah, I'm still here. Good afternoon, everyone. Good afternoon, Mr. George. Before I go ahead, I must really commend you, sir. You have indeed, with your choice of words and explanations, shown a depth of expertise in this field, and I really appreciate that we have the privilege to hear you. I mean, I don't know how I would have been able to meet someone like you or come across your kind of person if it were not for the privilege we've been given by JIIPCC Academy. But thank you so much, sir, for the knowledge you've shared with us today.
Okay, now I'm blushing.
Well,
Thanks, man. Thanks. Nice one.
You deserve your flowers, sir. So for me, I really want to diverge a bit with my question. It's not solely on fintech anyways, but there is a nexus between the both of them, right? So I'm a systems engineer, right? And I actually intend to build a particular prop tech software. And when you started, I realized that there was actually a lot more to consider. I mean, there's this whole excitement of getting a novel idea, or sometimes not even a novel idea, but an existing idea, and then you having like several other factors that you want to furnish to make the idea better than what it already is. So it's a prop tech. But then again, while I was speaking with a friend of mine about the idea, he mentioned some things that were very vital, and it also included holding monies of people that would subscribe, because it's one that would require payment, right? People have to pay to facilitate their transaction. And in order for the transaction to be seamless, we're considering a stage where the money will be held in the system. The system would be like something that would interface between those that are sending and those that are receiving. And upon conclusion of the transaction, those who are receiving will get it. Now, the idea is this, so that people don't get defrauded. So it would only take when someone has said, I am satisfied with the service, that the money will be transferred to the receiver. So if the person who demands the service is not satisfied, then the money will be reverted back to him. Do you get the picture I'm trying to paint? Hello, sir.
Go on. I can hear you. Don't worry. Just go on. Go ahead. Let's finish.
All right. So at the point where the money will be held between, or will be held before the sender has said, okay, I'm satisfied, and then the receiver will receive, the money will have to be in the system of this prop tech. So while it's not expressly a fintech like say OP or PalmP or the likes of them that facilitates transaction, it would be one that would have to deal with financial transaction. So my question is this. Now, what are the legal boundaries that would exist in such a software? Would it have to go through the processes or get the certifications or authorizations that a fintech industry would need to have, like those fintech licenses and the likes of it? And then the next is, since it would involve finance and it's in the tech space, what is the best approach to integrate payment legally? So those are my questions.
All right. Thanks. What's your name?
My name is Howells.
Howard. Yeah. So I was going to initially give you a very I was going to initially I would have probably give you a very concise response, right? To say now this goes a bit deeper into what do you call it now? Personalized consulting, right? But with all the praises that you showered on me, you bought yourself a consultancy service already. So I would answer you,
Thank you.
very
Thank you, sir.
deeply. Yeah, yeah, don't mind me. So you see, you have actually mentioned two things here, whether consciously or unconsciously, right? And which is why you hear me say, you see, one has to step away from right the fancifulness of having or launching a company to going into the understanding of what you want to do, the service that you're providing, right, and how you're going to make money from it, right? Now, the word prop tech, right, is a fancy lingo used for used for um, tech companies or tech services that deals with properties, right? So you see some sites where you can uh, you see some sites where you can get access to rentals. You see some of them whereby they will try to do the crowdfunding of property purchases, where you invest in a unit of a particular company, particular property, and then that's your money that you're paying gives you a partial ownership to that property. So as they are renting it out or doing whatever they are doing with it, the money they are making from it, they are sharing it with everybody that have bought different investment units in that property. So the flat is worth 50 million, and they say, okay, for every 1,000 you have one unit. So they divide the 50 million to 50 5,000 units, and then whatever income is made is shared according to the units that you bought. So different kind of models, right? But all connected to property business, basically the property industry, and that's where that lingo prop tech comes from. It's a short form of property. So if you're going into prop tech, like you called it, forget the fancy word of prop tech and say, what exactly are you going to do? What exactly is your prop tech about, right? What is that service? What is that thing around property that you're dealing with? Now, the future of what you've described, I think somebody even helped you out in the comments. I think I saw it's called escrow, right? Being able to hold money, right, that a buying person is letting go on, being the referee, so that until value has been actually given and confirmed to have been received, then you are releasing the money to the seller, right? Or to the person that is actually selling the money. That on its own is a service. So if you're going to say you want to do escrow as a service, right? It should be clear that you want to be in the business of helping people. So it can be a service that people can now put in their own shopping sites, or in their own on their own websites, or in their own businesses, to give their buyers extra levels of comfort, right? To say, hey, there's an escrow, pay with escrow. There's an escrow service whereby we don't get monies until you've confirmed that you have received value, and that escrow service is powered by you, Howells, whatever you call it, right? That is not the prop tech itself. Now, if you want to bring in this escrow service into a prop tech, so you want to bring in escrow into your prop tech, the escrow service is not your what do you call it now? It's not your core business, right? It's a future, right, in the prop tech to give buyers or potential customers more comfort to patronize you, or more comfort to part with money. But it's not your core business if you're bringing it into a prop tech. So you should be first and foremost in succinctly clear about what it is that you actually want to do, right? As per when it comes to what service are you or what business are you into? Are you into property tech, right? AKA prop tech? Are you into escrow services, right? Whereby you help people mediate, you help a buyer and a seller to play the mediation role in the middle until one person confirms that they've gotten value, then you release the money. Is that the business you want to go into? Or you have a property tech business that you want to bring in these escrow capabilities on it. So your clarity, firstly, it should be the first thing that you do, right? And then when it's clear, then it's easier to give you advice around what sort of legal or compliant related thing that you have to deal with, right? If you're going to do escrow as a service, for example, is a different kettle of fish than you're doing property tech, right? The legal basis or the compliance related thing that you will deal with doing property tech completely different from when you're doing escrow as a service, right? The guys that you need to interface with doing property tech is different from the guys that you interface with, right, doing escrow as a service. Now, even within the property tech, it depends on what exactly you're doing. Also, would also play a role in determining, the compliance or legal, elements to it. If you're doing property investing, if your prop tech is into investment, for example, it's different from where your prop tech is into promoting, what do you call it now, rentals, right? If you're just basically an online agency platform where people come to look for houses to rent or buy, it's a complete kettle of fish from when you're offering investment as a service, right? Property investment as a service. So all these different things. So even within the prop tech itself, still has different elements to it or different things that you need to deal with. Depends on what exactly you're doing in prop tech. So maybe when you get that level of clarity, then you can now dig deeper into exactly what legal or what compliance related elements that you might need to you are likely to encounter, right, in that business. So first of all, clarity is your most important thing right now. I hope you got me.
Yes, sir. I got you very clearly, very clearly. I have been listening to you very keenly. And then, please, I would like to ask, right? Thank you very much, by the way, for your response. Your response came with a depth of enlightenment and yes, enlightenment. Basically, that's the word I'm looking for. So, but please, sir, I would like to know: is it possible that we can reach out to you um, outside this program, perhaps for the personal consultation as you earlier started with?
Reaching at me, I'm not very difficult to find. You can easily get across to me via either through JIIPCC or through LinkedIn. I'm very sparingly active on LinkedIn these days, right? So you can reach me on LinkedIn. You can just send me a connection request, and then once I accept, you can always chat me up, right? And then you can also then drop any messages. I know I come in there frequently, and then I respond to queries of people ask, and then if there's a need for one-on-one, I'm sure that can be arranged in one way or the other. Sometimes that can be very up and about, right? So sometimes time is a very, very major resource for me. Yeah, but if there's a need for it, if something I can just respond to you with a few lines of messages, I'm sure I'll do that without wasting time. You get.
All right, so that would
So
be
just
problem.
just type my name, George Onyewuchi, and then you get it on LinkedIn. Just send me a connection request.
All right, sir. I will do that right away.
That's fine.
All right. All right. Thank you, Mr. George, and thank you to those who asked questions in regards to today's topic. We have come to the end of today's session, but just before we go, as is within our practice, please we would like to quickly take pictures. So for those who have their videos camera on, please can you just kindly turn on your video camera or your camera on so that we can take a quick screenshot from the session, and then we'll just call it a quiz on class. All right, thank you, Olayemi. Can we have more mentees respond? Sorry. Do we have more people who can respond? I really appreciate if you can have more mentees turn on their videos. Okay, that's fine. We've come to the end of today's session. Okay.
So I can join pictures as well.
All right, thank you, Precious. Someone else still trying to join us? All right, thank you, Mr. Harrows.
You're welcome, sir.
Okay, so we're done. Thank you everyone for joining in for today's session. You know, it was really an insightful session. Well done to the two groups for making their presentation and presenting in class. Thank you so much, Mr. George, for sparing out of your busy schedule to be here in today's session. We are really, really happy and excited to have you with us. We look forward to having every member here in class in our next class, that is next week, Saturday. I'm sure we still have quite a lot of interesting topics to address and deal with. And just sit back. Our mentors that we have scheduled for those classes, I'm sure that they are going to bring their A game to driving home this subject or this course called FinTech, the FinTech industry. So please kindly do well to fill in the attendance for those who participated. For those of you that are in class now, do well to fill in the attendance, share what you've learned on LinkedIn and other social media platforms. Do not forget to tag us, right? And tag our mentor. You can always do well to connect with Mr. George Onyewuchi. You can just search him out on LinkedIn and do that connection or make that connection and reach out to him if you have any further questions. Thank you everyone once again, and do enjoy the rest of your day. Goodbye.